Back of its Q4 numbers, the bank's net interest margins improved to 4.24%, which compares with 4.04% a quarter ago, though it's lower compared to year-on-year. Profits have declined both annually and on a sequential basis. To discuss the numbers and the way forward, we're joined by S. Krishnan, MD and CEO of the bank. Mr. Krishnan, morning. This is Reema here, and thank you very much for joining in. First, if you could explain the sequential improvement in your net interest margins. Is it sustainable, and what can you guide on margins going ahead?
Thank you, Reena. Very good morning. As far as the net interest margin is concerned, the net interest margin has been the last year, 23-24, has been consistently on the upward movement. To recapitulate, I can say that in Q1, the net interest margin was 4, it moved to 4.1, and in Q3, almost at the same or a little less at 4.08. And Q4, we could get 4.24. This net interest margin, we were able to have because, one, we are very cost conscious. That is the reason that we have been utilizing the funds available with us to a great extent, leveraged that, and had a CD ratio of 80%, which was very comfortable. And going forward, I expect that my net interest margin will be definitely 4+. That is what the guidance I gave last year also. And we are able to. Of course, when I compare this net interest margin for the year 23-24 with the previous year, it has come down. It is basically because the entire industry, the cost of deposits had gone up, and TMB is not an exception. That is the reason. However, we see that it is stabilized and we will be able to maintain this. Again, for the guidance, I can say that I will be able to maintain NIM of 4+.
Okay, Mr. Krishnan, so your shareholders will like that you're saying that NIMs will remain at 4+, but then you're saying that the next couple of quarters there will be a slight moderation, because I mean at the end of Q4 FY24 you were at 4.24. So yes. Fair to expect a 20-25 basis points sort of a moderation?
No, I don't say moderation. In fact, I may be able to maintain, but we have to wait and watch how the interest rate moves. Because now there are, as of now, if I take, yes, currently it may be flat. I don't expect that the interest will move northwards immediately. I also don't expect that there will be a rate cuts in the near future. That is my expectation. If that being the case, the net interest margin will be hovering around this. But as a range, I said that it will be 4+.
So just to go back on the asset quality point, your write-offs quarter on quarter were slightly higher. You had write-offs of about 53 odd crores. So can you give us some idea about the the expected rate of slippages going forward, and whether write-offs will continue to remain high in the coming quarter as well?
See, as far as the slippages is concerned, I can say that the slippages are very much contained. My slippage ratio for the full year is 1.36, while for the quarter it is only 0.16. In fact, in Q2, we had a little higher slippage. That is the reason it went to 1.36 for the year. Otherwise, the slippages are always under control. I will like to draw the reference to the SMA book. The SMA book, which was 6.51, has come down less than 4% now. That clearly indicates that, yes, we are able to have a better loan book. And going forward, my slippages is expected to be very minimal. I don't expect big accounts which are in the radar of slippage. As I said, SMA was 6.51 previous year, and 23-24 March, it was 3.97. That clearly indicates that we are able to have a better asset quality. Going forward, the slippages are expected to be the minimal.
Write-offs, sir? I mean, as I said, write-offs were quarter on quarter, they were more than usual. So why the high write-offs?
Yes. No, write-off, I don't expect in coming quarters to this extent. Probably whatever was there, we were cleaning the balance sheet, which were fully provided already. So we have done that, and I don't expect that there will be further more write-offs like this.
So then, sir, let's talk about the business now, the growth of the book itself. Your advances quarter on quarter were up about 4.2%. I mean, when we're looking now, we're talking about FY25. What is the visibility, or what's the target you've set for yourself in terms of growth in advances?
In terms of growth in advances, it should be 12 to 15%. That is what I say that we will be able to do. Why? I can say that the year 23-24, the bank had undertaken a transformation project. We have been transforming the processes and also the products. We had put in place various systems. Basically, the bank focuses on the MSME. So we took the business process engineering first phase for the MSMEs. We have established the MSME hubs in different locations. I have 12 regional offices across the length and breadth of the country, of which 9 locations I already established the hubs. So the underwriting process have been centralized in these hubs, which will ensure the quality of the underwriting, so that going forward, asset quality is ensured. Second, we have also put in place a relationship manager's role, where I am assigning the customers to specific officers who will be the relationship managers for them. And I'm also having this year the plan of having feet on street for lead management. So these things I expect that will come handy for the bank to see that we are able to achieve the estimated level of around 12 to 15% in this current year.
So loan growth guidance you've shared, can you share do you have a deposit growth guidance in mind?
Deposit growth also will be around that. In fact, I will be having a business strategy meeting of the board very shortly, after which definitely I will be able to give the detailed guidance to the street. But I think that the estimated deposit growth will also be around 12 to 15% by and large.
Okay. All right, sir. We'll leave it on that note for today. Thank you very much for giving us more details on the business at the end of Q4. There you go. That's Tamilnad Mercantile Bank.